Hey everyone, good morning. We just had our first negative 1% day in the stock market for the first time in almost 2 months. For the first time since late March, the stock market dropped 1.2% last Friday. There are a ton of things that you need to watch out for this week. If you watched my last Sunday video, I told you that I was starting a position in MRAM. I expected this position to take a little bit longer than it did to actually play out. However, we were up 160% on this position within just a week as the market cap went from $400 million to over $1 billion. I closed that position up 160% on MRAM. However, I am going to give you a blueprint here as to how to tackle the market going forward. This is everything that you need to watch out for this week and how to take advantage of it from a trading and investing perspective. We are coming up on a historically bearish timeframe for equities. From May to October, in midterm election years, the market tends to see a correction. The average drawback is minus 10 to 12%. However, I want you guys to recognize something very important here. There are no years in that specific historical downside dataset ending. In the number 6, 1986, as well as 2006, those specific years were actually positive for the index. Right now, we have a year ending in 6. That is a very small sample size, but historically May to October and midterm election years tend to be pretty bearish timeframes. Now, although we have a new Federal Reserve chair that is supposed to start soon, the central bank named Jerome Powell as chair pro tempore until the replacement is officially sworn in. There is no date for the new chair being sworn in, although I believe the confirmation by Congress went through. The swearing-in date has not been set in stone yet, and Powell will remain basically the de facto Fed chair until we have that ceremony. I shared with you that we also tend to see a pullback during the first few months of a new Fed chair as the market tends to test the central bank leadership. There was also a high-profile summit between China and the United States last week. China said that it reached a tentative agreement with the United States on some tariff reductions and trade cooperation by committing to buy commercial airplanes. They also said that even though the United States allowed them to buy the advanced semiconductor chips from NVIDIA, they are not going to buy them because they do not need them. I do not know if that is just geopolitical grandstanding or what the actual underlying motivation is there. Speaking of NVIDIA, we do have NVIDIA earnings coming up on Wednesday after the closing bell. I believe that they are going to beat earnings and they are going to beat revenue, and it will likely be a record quarter, but obviously everyone is going to be focusing on the future guidance. We also have the massive tech initial public offerings coming down the pipeline, but that is for later. In terms of how to trade this environment, I told you guys about using the 9 and 21 exponential moving averages on the artificial intelligence build-out stocks. I previously gave you a list of some artificial intelligence build-out stocks. However, I have a complete list for you of all of the individual stocks that I am tracking from an artificial intelligence build-out perspective if you just look for the resources I provide. I will send you the breakdown absolutely free, detailing the complete list of artificial intelligence build-out stocks. As I said, you can trade these actively from the 9 and 21 exponential moving averages. If you followed that methodology, look at what happened with companies like AAOI, for instance, which is a key photonic stock. You could see that from the 9 and 21 exponential moving average setup just last week, it went up 53%. Same thing for Light, which is Lumentum Holdings. If you followed that tip from the last video, Lumentum Holdings was up 21%, so on and so forth. Coherent, which is another major photonic stock, showed the exact same thing, jumping right off the 9 and 21 exponential moving average support line. As I said, you want to take advantage of this micro trend until the trend is no more. I do not care what the historical statistics say about midterm election years. A lot of these specific momentum stocks are not even in the SP 500 or the NASDAQ index. As I said, I think that the current market cycle is focusing heavily on photonics and physical data centers. Look at Nebius, which also made another all-time high, bouncing perfectly off the 9 and 20 exponential moving average. Now, if this trend breaks, then yes, you stop executing this play because the trend is your friend until the end. When this trend breaks, then you will know that is the exact time to let your foot off the gas a little bit on this specific technical strategy. With the artificial intelligence build-out stocks, we might also be seeing an early rotation into software. Look at IGV, which is the tech software exchange. Traded fund, it is up a quiet 25% since April. I did a whole fundamental write-up on ServiceNow as well, creating a whole thesis for long-term investment. Looking at their free cash flows, looking at their cash from operations, looking at their EBITDA, and looking at their total revenue, these all look like textbook linear growth graphs. It almost looks too good to be true, But ServiceNow is a company that is growing by all of the important metrics that you want to see a company grow by at a very consistent pace. Shout out to advanced fundamental tools that let us track these corporate metrics cleanly. Could we be seeing a broader rotation into software as Microsoft also looks like it wants to break out? Although it did drop a little bit after hours on Friday when it was announced that its original founder had liquidated the remainder of his position. To me, that liquidation is a complete non-issue. That founder sold most of his stock a long time ago, and he actually missed the opportunity to become a trillionaire because of selling most of his equity very early before this massive pump to the mid-500s. So for me, that individual selling his last bit of shares is not something I care about. He already missed this entire historical pump on the stock and sold way too early, missing out on a chance to become a trillionaire. If we do get a macro dip in the indexes, that is going to be an absolute gift. The S&P 500 has been on a massive win streak, and historically, 52 weeks after these streaks. The index has never been negative. Now, I am honest with you guys, and I will tell you straight up when I do not know something. Is the S&P 500 going to see a deep correction right here? I do not think that we are going to get a standard major correction here just because we had one bad day, but I do think that the market will likely test the Federal Reserve, especially after the first meeting or two under any new structural shifts. So I do think that we will see a standard correction at some point. I just do not know that correction starts right now just because we had a red candle last Friday. But if we do get a pullback, that is 100% a viable buying opportunity. I think that the artificial intelligence build-out is still fairly early in its macro cycle. I think that there is still more market euphoria to go. And I think that the market will likely see a full rotation into things like software before there is a major secular bear market or a major correction, maybe in the near future. I do not think that a final top happens without these laggard stocks also flying high. Now, crude oil is still hovering at above $101 a barrel. Obviously, the international shipping straits issue is not solved whatsoever. This, to me, does not bode well for the market at all over the longer term. The market spending almost 2 months with crude oil hovering around $100 means an economic slowdown is almost guaranteed at some point because of these energy costs. We already started seeing consumer price index metrics come in at levels that we have not seen since the peak pandemic era. The consumer price index came in at 3.8%, the highest level since mid-23. Core inflation also rose to 2.8%, which was above Wall Street expectations of 2.7%. The worst macro numbers of all were found in the producer price index. The producer price index surged to 6%, well above the consensus expectations of 4.5%. We have not seen wholesale prices rising this fast since early 23. Core producer prices came in at 5.2%, above expectations of 4.3%. The longer that inflation sustains at these hot levels, obviously the Federal Reserve is not going to be able to cut interest rates. I do not think that this central bank is actively going to raise rates, but the statistical chances of a rate hike are higher than a rate cut for sure, because of this underlying data. I think that the structural chickens will come home to roost possibly very soon, so I do think that there is still more market euphoria left in the short term, and it is our job to try to take advantage of that operational opportunity. But I do think that it will end badly at some point down the road. So, you are really going to have to play this market cycle tightly. You are going to have to know when to manage your risk, when to take profit, and when to put your foot on the gas. If you want access to all of my long-term analysis, as well as my swing trades, such as our entry in MRAM, as well as the data center stocks, make sure you look for my platforms. Get yourself the best fundamental analysis tools available, because it will do wonders for your portfolio and your overall ability to pick high-quality stocks. Go ahead and secure that free breakdown detailing all of these momentum stocks in the artificial intelligence build-out. I look forward to seeing you guys in the next video. Stay safe out there, traders. Let us talk about the absolute core reality of long-term investing, because too many people get blinded by short-term green days. When you enter a volatile macro environment, your primary goal is capital preservation combined with aggressive discipline. I see so many retail investors throwing their hard-earned money at hype cycles without looking at a single balance sheet or free cash flow statement. That is exactly how you get wiped out when the market finally turns. If you want to survive as an investor, you need to understand the structural pillars of market cycles. Every single major growth wave goes through an infrastructure phase, followed by a platform phase, and finally a software application phase. Right now, we are transitions from the hard infrastructure of physical chips and data centers into the platform and enterprise software layer. This is not a random guess. This is a historical pattern that has repeated itself across every major technological shift over the past 50 years. Look at the internet. Boom. Look at the mobile smartphone transition. Look at cloud computing. First, the market funds the hardware and the fiber optic cables. Then, the market rewards the companies building the foundational architecture. Finally, the massive sustained cash flows move into the software systems that run on top of that architecture. If you are still only buying hardware companies at peak valuations, you are late to the macro party. You need to be positioning your capital where the puck is going, not where it has already been. That is why I am heavily analyzing enterprise software models that have locked in recurring revenues and massive pricing power. When inflation stays high and energy costs surge, corporations look for ways to cut internal operational costs. They do not do this by buying more experimental hardware. They do this by implementing software solutions that maximize their existing efficiency. This means companies with robust software suites are going to see their enterprise adoption accelerate, even if the macroeconomy begins to slow down. This is the hidden value pocket that the mainstream financial media completely glosses over because they are too busy reporting on day-to-day price action. You need to train your mind to look past the immediate noise and focus entirely on structural market flows. Look at the bond market right now. Look at how yields are reacting to the sticky inflation data. The bond market is pricing in a higher for longer interest rate scenario, which means liquidity is going to get significantly tighter for unprofitable growth companies. If a company relies on cheap debt to fund its daily operations, that company is a ticking time bomb in this environment. You must focus on corporate balance sheets that are completely flushed with cash and generating positive free cash flow every single quarter. Cash is king when interest rates are sitting at these elevated levels, because cash allows these massive tech giants to buy back their own stock and acquire smaller competitors at deep discounts. This is how the strong get stronger while the weak get completely eliminated from the index. As an independent investor, your job is to align your personal portfolio with the absolute strongest players in the market. Do not try to catch falling knives in speculative small-cap companies just because they claim to have an artificial intelligence strategy. Look for real verified revenue growth, look for expanding gross margins, and look for sustainable leadership teams. I track these corporate metrics every single day because data is the only weapon we have against market uncertainty. When you have a clear data-driven thesis, a 1 or 2% drop in the SP 500 does not scare you. Instead, a red day becomes a highly tactical buying opportunity to accumulate your high-conviction positions at a relative discount. You must remove all emotion from your trading process. If you get excited when your portfolio is green or depressed when your portfolio is red, you are gambling, you are not investing. Develop a strict dollar-cost averaging strategy, set your technical indicators, and follow your own rules. Without exception, the trend is your absolute friend until the exact moment it breaks. And when it breaks, your risk management parameters must take over immediately. Never let a short-term swing trade turn into a long-term bag-holding situation just because you refuse to admit you were wrong. Take your profits when your targets are hit, protect your principal capital, and always keep a healthy cash reserve ready for unexpected market dislocations. The global geopolitical landscape is adding another layer of complexity that every investor must account for. With energy prices staying elevated, the cost of manufacturing and global logistics is going to remain a persistent drag on corporate profit margins. This means you need to favor asset-light businesses that do not rely on massive physical supply chains to deliver value to their customers. Software is the ultimate asset-light business model because once the code is written, the marginal cost of replicating and distributing that software is virtually zero. This gives software companies an incredible structural advantage during an inflationary cycle compared to traditional manufacturing or capital-intensive hardware industries. This is the exact core framework of my entire portfolio strategy as we head deeper into this year. I am balance my high-momentum, short-term technical trades on photonics and data center infrastructure with core foundational long-term investments in high free cash flow enterprise software. This dual approach allows me to capture the immediate upside of the current market euphoria while establishing a highly resilient defensive posture against structural macro risks down the road. You do not need a fancy financial degree or a background on Wall Street to execute this successfully. You just need the discipline to ignore the sensationalized headlines, the patience to wait for your specific technical setups, and the tools to verify corporate fundamentals. Stop listening to the talking heads on corporate television who change their market outlook every single hour based on the latest tick of the index. Focus on the weekly charts, focus on the macroeconomic data trends, and protect your capital at all costs. The market will always punish undisciplined participants and reward those who approach the game with a clear long-term plan. Make sure you are constantly refining your strategy, staying objective, and executing your plan with absolute precision. We have a massive week ahead with major earnings reports and critical economic updates that will set the tone for the summer months. Keep your eyes on the moving averages, stay disciplined with your position sizing, and never risk more capital than your risk tolerance allows. I will be tracking every single one of these structural moves and breaking down the raw data as it hits the wire. Make sure your notifications are turned on so you never miss a real timely market update. Let us navigate this volatile cycle together, build long-term wealth, and stay ahead of the institutional capital flows. Thank you for spending your valuable time with me this morning. Stay sharp, stay focused, and I will see you all in the very next breakdown.